how do you invest to make sure you don't lose your money? It depends on your strategy. Investing without a plan is like a sailing without a chart and passage plan. You'll drift aimlessly and risk hitting a rough water. But with the right strategy, you can manage the risk, grow your wealth, and achieve your financial goals. In this video, we will dive into the most effective investing strategies, from diversification to dollar cost averaging, and help you to choose the one that suits your goals. Ready to invest smarter? Let's get started. Investing isn't one size fits all. It's a journey shaped by your goals, risk tolerance, and the time you're willing to commit. Strategies act as your compass, guiding how you allocate resources, handle risk, and pursue growth. From approaches designed to cautious investors to those favoring bold, high-reward moves, each strategy has its own purpose. Understanding these options helps you to make informed decisions and build a plan that aligns with your needs. Now, let's explore the key strategies and what each of them can offer an investor. Diversification strategy. Diversification in investments is a risk management strategy that involves spreading investments across various financial instruments, industries, and other categories to reduce the impact of any single investment's performance on overall portfolio. Different asset classes like stock, bond, real estate respond differently to the market events. Diversifying reduces the likelihood of investment underperforming simultaneously. It also may limit the big gains. However, it helps to protect against significant losses, ensuring more consistent returns over time. Also, spreading investments helps smooth out the fluctuation of portfolio's overall value. Diversification has quite a few negative sides, of which over-diversification. Spreading investments too thin can dilute returns. Global financial crisis affects all assets, so it doesn't protect against that kind of events. Management complexity. Monitoring and rebalancing a diversified portfolio requires effort and expertise. Anyway, to diversify is pretty simple and depends on each individual how you want to do that. Across asset classes, mix stocks, bonds, real estate, commodities, etc. Within an asset class, different stocks or bonds, by geographic region, by investment style, whether you're a passive or active investor, or using funds and ETFs, inherently provide diversification by holding a variety of assets. Diversification is a critical strategy for long-term investors to mitigate risk and stabilize returns. Simple example. Imagine an investor allocate portfolio as follows. If the United States stock market drops, the international stocks or bonds might perform well, balancing the overall portfolio. Dollar cost averaging. Dollar cost averaging is an investment strategy where an investor divides a total investment amount into equal parts and invests at regular intervals, regardless of asset price at the time. This method is particularly popular among long-term investors and those wanting to minimize the emotional aspect of investing. Instead of investing a significant amount at once, an investor might commit a particular amount like $500 each month into mutual funds, stocks, cryptocurrencies, or other assets. Over time, this strategy ensures the investor buys more units when prices are low and fewer units when prices are high. DCE reduces risk of market timing, where you predict the perfect time to invest, which is notoriously difficult. Also, minimizes emotional behavior, like panic during market downturns or euphoria during market booms. Regular contributions promote discipline and reduces the impact of emotional decision making. Few more advantages include lower average price per unit over time, and it is budget-friendly strategy, where you can choose appropriate amount that one will not damage you financially. However, DCA doesn't protect against overall market declines or poor performing investments, and it is a slower wealth accumulation strategy. In conclusion, DCA is a valuable tool for investors looking to build wealth steadily while minimizing the psychological and financial risk of market volatility. Best fits for long-term investments and volatile assets for new investors. Simple example of DCA in action. Even though the stock price fluctuated between $35 and $55, the DCA strategy allowed the investor to build a position at average price below the current market value, $44.79 versus $55. This approach minimizes the risk of timing the market and leverages the power of systematic investing. Dividend investing strategy. Dividend investing focuses on purchasing stocks or other assets that pay regular dividends, providing investors with a steady income stream. Dividends are payments companies make to shareholders, typically derived from profits. This strategy is popular among income-focused investors, retirees, and those seeking a balance of stability and growth in their portfolios. One significant benefit of dividend investing is the potential for compounded returns for the dividend reinvestment, which can substantially boost wealth over time. Additionally, dividend-paying stocks or ETFs tend to be less volatile than non-dividend-paying growth stocks, offering the level of protection against sharp market declines. However, this stability often comes with a slower price appreciation, as dividend-paying companies may prioritize consistent payouts over aggressive growth. How to start investing in dividends? First of all, dividend investing involves identifying companies with a history of consistent or growing dividend payments like blue-chip stocks, such as Procter & Gamble, Johnson & Johnson, or dividend-focused ETFs. A key aspect to consider is dividend yield, which indicates the annual dividends as percentage of the stock price. It can be calculated using the formula: annual dividends divided by stock price times 100. For example, stock price at $50, it pays at $2 annually, dividend has a yield of 4%. Another important metric is the payout ratio, which measures the portion of a company earnings paid out as a dividends. This is calculated as dividends divided by earnings times 100. Lower payout ratio, typically below 60%, often suggests sustainable dividends. Investors should also evaluate the dividend growth rate, which reflects how much a company has increased its dividends over time. Companies with a consistent track record of annual dividend increases are usually more reliable. Finally, it's essential to pay attention to the ex-dividend date. Owning the stock before this date is necessary to qualify for a next dividend payment. Another important question is how to build a dividend portfolio. Diversification. It's important to not put the whole portfolio in a single company or industry like utilities or energy. Consider international dividend-paying stocks, ETFs, or high-yield funds. Monitor on their balance regularly. Ensure your portfolio remains aligned with your financial goals and risk tolerance. Simple example. Let's assume we want to build a diversified dividend portfolio with $5,000. You decide to invest in three industries: technology, consumer staples, and utilities, targeting companies known for stable dividend payouts. That means you're earning steady $226.7 annually in dividends, which you can reinvest. What's more, the value of dividend company may increase over time, making your dividend payments even higher. In conclusion, dividend investing can provide stability, income, and growth potential when executed thoughtfully. It's a powerful strategy for building wealth for a long term, especially when reinvesting dividends and maintaining a diversified portfolio. Index investing. Index investing is a passive investment strategy that involves building a portfolio designed to match the performance of a specific market index, such as S&P 500, Nasdaq 100, or FTSE 100. Instead of picking individual stocks or actively managed funds, investors buy index funds, or exchange-traded funds, ETFs, that mirror the composition of an index. Index investing provides diversification by offering exposures to a wide range of companies, such as those in S&P 500, while keeping costs low. Due to the minimal trading and management, it simplifies investing, it requires no individual stock research, and often delivers consistent performance by tracking market trends. This approach also helps reduce emotional decision making by encouraging long-term focus. However, index investing has risks, meaning values can decline during downturns. It lacks flexibility as markets don't adjust to the market changes or exclude underperforming stocks. Additionally, it may miss high growth opportunities and could overweight large companies in market capitalized index like S&P 500. Key metrics in index investing. When investing in index, several key metrics can guide your decisions. The expense ratio measures the cost of managing the fund, with lower ratio being more cost effective, ideally below 0.2% for ETFs and 0.5% for mutual funds. Tracking error reflects how closely the fund matches the performance of its index, with lower tracking error indicates the better alignment. Additionally, the dividend yield shows if the index pays dividends, which can boost the total returns over time. How to start index investing? Begin by determining your goals, whether you are investing for retirement, building wealth, or achieving a specific financial target. Next, select an index fund or ETF that aligns with your objectives. Popular options include Vanguard 500 Index Fund for S&P 500, iShares Emerging Market ETF for emerging markets, and SPDR Dow Jones Industrial Average ETF for Dow Jones. Invest regularly using strategies like dollar cost averaging to mitigate market volatility, and diversify across index for broader exposure, such as combining United States, international, and bond funds. Finally, hold your investing for long term, 5 years or longer, to maximize the benefits of compounding. Simple example of index investing. Investor puts $10,000 into S&P 500 ETF and adds $500 monthly for 20 years. Assuming an average annual return of 7%. Historical return of S&P 500 after inflation. Ending value is around $263,000. This growth comes from compounding returns and consistent investing. In conclusion, index investing is a proven strategy for long-term wealth building, offering diversification, low cost, and simplicity. While it not may outperform the market, it ensures consistent exposure to market growth with minimal effort, making it a cornerstone for many successful investment portfolios. Value investing. It is an investment strategy that focuses on buying undervalued stocks based on their intrinsic value. It seeks opportunities where the market price of a security is significantly lower than the true worth, often referred as the margin of safety. Value investing focuses on buying undervalued stocks. Investors estimate the intrinsic value of a company by analyzing its fundamentals, such as earnings, revenue, assets, and cash flow. More ratios to analyze includes price to earning ratio, price to book ratio, free cash flow, debt to equity ratio, and many more. They then compare this value to the market price. Buying stocks at a significant discount to their intrinsic value reduces the downside risk. This cushion protects against unforeseen market volatility or valuation errors. Value investors typically hold onto investments for extended periods, allowing time for the market to recognize and correct undervaluation. It is important to underline that value investors often go against the herd, buying when others are selling due to fear, vice versa, and decisions are made based on analysis and evidence rather than the trends or rumors. But how to apply value investing? Firstly, identify potential stocks. Look for companies with strong fundamentals and history of stable earnings, cash flow, dividends, and other metrics. Second, conduct fundamental analysis. Analyze financial statements, balance sheet, income statement, cash flow statement to assess the company's health. Third, estimate the intrinsic value. And that part could be a tough one. You could use valuation models such as discount cash flow or earning multipliers to determine the stock's true worth. Fourth, evaluate the margin of safety. Ensure a sufficient discount exists between the intrinsic value and market price. Fifth, monitor and review. Regularly review your portfolio to ensure the investment thesis remains valid. Value investing offers several benefits that make it an attractive strategy for long-term investors. It has the potential for significant returns by identifying undervalued stocks, reducing downside risk through a margin of safety, and enabling wealth accumulation over time. Moreover, the approach relies on evidence and fundamental analysis, rather than the market speculation, fostering informed decision-making. However, value investing also comes with challenges, particularly for beginners. It requires patience and discipline, as the strategy often underperforms in bull market, or when the market is driven by speculative trends. The process is time-consuming, involving detailed analysis of financial metrics and reports. Additionally, the risk of valuation errors can lead to misjudgment, emphasizing the need of experience and solid understanding of financial analysis techniques. Classic examples of successful value investing include Warren Buffett's investments in Coca-Cola, American Express, and Washington Post, where he identified strong companies trading below their intrinsic value and held them for long-term gains. Growth investing. Growth investing focuses on identifying companies with significant potential for above-average earnings or revenue growth. These companies typically reinvest their profits to expand operations, develop new products, or capture larger market shares, which can lead to substantial capital appreciation for investors. In simple words, it is an investing strategy in companies with high growth potential. The core principles of growth investing include prioritizing earnings growth, focusing on industry leaders with innovative products or technologies, embracing the higher risk associated with potential high rewards, and maintaining the long-term vision to supply the company's growth trajectory. Additionally, growth stocks are characterized by high revenue growth, expanding market share, reinvestment of profit into growth initiatives rather than paying dividends, and possessing an innovative edge that distinguishes them from competitors. This combination of strategic principles and defining characteristics enables growth investors to target companies poised with substantial capital appreciation and sustained market leadership. How to apply growth investing? Firstly, identify growth sectors. Focus on industries with strong expansion potential, such as technology, healthcare, or renewable energy. Second, evaluate financial performance. Look for consistent revenue and earnings growth, strong margins, and reinvestment strategies. Third, consider growth metrics. Analyze metrics like earnings per share growth, return on equity, revenue projections, and others. Fourth, assess competitive advantages. Ensure the company has sustainable competitive edge through innovation, branding, or market leadership. Fifth, monitor performance regularly. Keep track of financial reports and industry trends to ensure the growth story remains intact. Growth investing offers the potential for substantial capital appreciation by targeting companies with strong earning and revenue growth. Benefits include focusing on industry leaders with innovative products, aligning with the future orientation sectors, and providing significant long-term wealth accumulation opportunities. This strategy is particularly appealing during bullish markets when growth stocks tend to outperform. However, there is quite a few challenges, including high valuation risks, as these stocks often trade at premium prices. The volatility of growth stocks can lead to significant short-term losses, making the approach unsuitable for risk-averse or beginners investors. Additionally, success requires diligent research and monitoring to ensure the growth potential remains intact amid changing market conditions. Iconic examples of growth investing include early investment in companies like Amazon, Apple, Tesla, and Google, where rapid revenue growth and market dominance led to substantial long-term returns. Investing is as much about choosing the right strategy as it is about staying committed to your financial goals. Whether you are diversifying to manage risks, leveraging dollar cost averaging to minimize market timing, or targeting steady income through dividends, every approach has its unique strengths. Which strategy do you think suits your investment goals best? Let me know in the comments below. Also, stay tuned for second part, where we'll cover a lot more investing strategies. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you'd like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.